Global equities gained 6% for the first 3 quarters of 2018, but experienced a sharp sell-off in October. US equities are up for the year, but other regions underperformed. Bonds also fell between 3 and 5%. Will market volatility continue in 2019? And how should investors position their portfolio to take advantage of potential opportunities? We spoke with Citi strategists on the market outlook for the year ahead. Ken, recently there's been questions whether the global growth momentum will continue. What's Citi's view on the outlook ahead?
Well, despite all these concerns, we actually don't think that global growth is going to fall off that much. For example, in the United States, we look for stimulus effects of the tax cut to be fading. But still, we'll be expecting somewhere between 2.5% and 3% growth next year, which is still above trend. In China, stimulus policies are just beginning to kick in, both fiscal and monetary, and we think there's more of it coming next year. There are risks, of course, the biggest one of which is the trade tensions between the US and China. We think eventually we reach a deal, but the process of getting there is going to take quite some time.
Are there still opportunities in this late cycle bull market?
Well, we think investors should definitely be selective, but there are opportunities to be had. We think the earnings growth in the US is likely to slow down fairly substantially because of the passing of the stimulus effects from the tax cut. In Europe, despite a lot of political tensions and uncertainties, growth has been fairly steady, just not as buoyant as what the US was this year. We don't think there's real risk of disintegration of the euro area in the coming year. Hence, we think there are some selective opportunities there as well. The biggest opportunity, we believe, is still in emerging markets, however. Now, in Asia, that's still our favorite emerging market because we see a much longer trajectory, a runway for growth, particularly in consumer wealth, incomes, and spending. And this is a region where technology and healthcare are also developing at a very fast pace.
Umar, in October, 10-year US Treasury yields reached 3.2%, a high since 2011. Given the related questions over the potential of inflation, what's the likely Fed response?
Well, we expect 2 Fed rate hikes in 2019, implying a terminal rate of around 3%. We've seen little interest from Fed officials in raising policy rates beyond neutral. And despite some slightly stronger job and wage data, we continue to expect inflation to remain around the Fed's 2% target.
What are some of the opportunities that bond investors can consider?
Well, we like US investment-grade corporates, where yields are slightly higher, spreads are materially wider. We also like US high yield. We expect default rates to remain relatively low against the backdrop of a relatively strong US economic outlook. In emerging markets, there has been volatility, but valuations have repriced substantially cheaper. We think that pressures on the emerging markets are likely to ease going into 2019, and so we see quite a few pockets of opportunity, and in particular we see long-term value in China.
Jai, the US dollar experienced an unexpected rally since mid-April. Is this trend likely to last in 2019?
We don't think this dollar strength is likely to last due to a combination of fading fiscal support and tighter Fed monetary policy that is likely to have an impact on US growth, albeit moderately. But the moderate slowdown in US growth will also pressure the financing of the US twin deficits. So all of this poses some headwinds for the USD in 2019. We think there are some negative risks for the euro spilling over into 2019, namely from Italy and the recent loss of economic momentum in the Eurozone. But during the second half of the year, we expect growth to pick up in the Eurozone and for the ECB to move to a less accommodative stance that will be supportive for the euro.
What's the outlook for Asia-Pacific currencies?
Asian currencies will be driven very much by what happens to the Chinese renminbi. Now, the Chinese renminbi is under some pressure because of US-China trade tensions and plus China adding stimulus to support its growth outlook. That will weigh on Asian currency sentiment. Out of all of this, the oasis of stability is probably the commodity currencies, where a better domestic growth picture plus inflows from these regions comes to support these currencies. I would watch for the Canadian and the Kiwi dollar in particular.
We hope you found these insights useful. For more information, please speak with your Citigold relationship